So he was able to tap into that insurance instead and was able to get some income to the family that he wasn't going to be able to get otherwise, because if he left work via or because of his disability and he couldn't do his job anymore because of that, he had no group insurance coverage because he hadn't qualified for it yet. He hadn't been at that job long enough, and he didn't have any personal disability insurance coverage. Now, he did have health insurance coverage, so that's good. So that may sound like kind of a strange solution to that problem, but it really worked out quite well. As opposed to having no income, there was a way to get some income. The reason why we have this whiteboard here, I feel obligated to use it, is because I think of money as a triangle. There's three kinds of money. Maybe I should turn this a little bit so we can see it better. Jake, you're probably not going to see it as well, but that's okay.
That's all right.
So we've got tax-free money, tax-deferred money, oops, if I can spell, and taxable. And let me ask you all a question. Which one would you rather have? You chuckled because it's obvious, right? You want tax-free money. Now, life's pretty simple in my world in some respects, because there's only 5 ways to get tax-free money. And one of those, and this is why this came to mind, Jake, one of those is an HSA, a health savings account, or a medical savings account is what it used to be called a few years back. Cafeteria plans, you might have heard that term before as well. Cafeteria plans are where it's a pre-tax reimbursement account. You put some money in off your paycheck into a pre-tax account, tax-deferred account, let's say, and if you use that money for your medical and dental expenses, your out-of-pocket medical and dental, that money comes back out of that plan tax-free. It's one of only 5 ways. And since I'm talking about this, I figure I might as well at least give you some more of the other ones here. Roth IRA. Roth IRA is for retirement only 529 plans. These are for education purposes, qualified post-secondary educational expenses. Municipal bonds, otherwise for short, the name is munis. I'll just put it up there as munis. And then what a lot of people don't realize is cash value of life insurance. If it's structured correctly, there's a way that you can access your tax-deferred cash value of life insurance in a tax-free way. So when we talk about how to pay for out-of-pocket medical expenses, in this example, I was going to say medical and dental, it's really through that HSA, or maybe could be through munis, and it could be through cash value of life insurance. But let me go a step further. Most people, and I've got so many examples of this, most people concentrate on building their money in tax-deferred and taxable vehicles. What I mean by that is 401ks, IRAs, those are all going to be under this tax-deferred piece. We're saving money for the future. It's a great way to build wealth in a tax-favored method. Of course, we all agreed that tax-free would be even better. And then once we cap out or max out what we can put into these tax-deferred investment vehicles, then we punt. We basically say, okay, default to taxable. The rest of my money I build up in a taxable position. Now let me ask you another question that may seem obvious. How many of you want to live on less money in the future than you do today? I don't see any hands raised. Nobody wants to live on less money. By the way, let me ask you another question. How many of you believe that taxes are going down in the future? Okay, I got a couple chuckles and no hands. All right. So it seems kind of weird to me, at least, that if we're building all of our wealth in a tax-deferred investment position, doesn't that suggest that if taxes are probably going to be higher in the future, and I don't want to live on less money, so I'm going to still need the same amount of money, and then therefore if all my money's here, or a lot of my money's here, and I pull it out of a tax-deferred investment vehicle, that would suggest that all of that money that I'm pulling out is taxed at that time. And that's where I have all these examples, hundreds of examples of folks who are struck by the idea that I didn't reduce my tax bracket in the future. I'm not able to pay less taxes like I thought I would. In fact, when I talk with business owners, I always ask the question, what's your exit strategy? And they look at me like deer in headlights and say, what do you mean, what's my exit strategy? I just started the business, or I'm still building the business, that kind of thing. Now, what are you striving to get to? What's the exit plan? And that's the same question I ask individuals. There's lots of exit plans. It's the exit plan from work. It's the exit plan from life. What are you going to do in these various examples? And you might find yourself thinking, well, I've never asked myself that question. Exactly, that's part of why I ask those questions, so we can put together a plan that we know is going to work for you. So my belief is that we need to have the end point in mind when we're thinking about saving money and building our assets up. We want to have choices in distribution just as we have choices in contribution. So if I asked you the crazy question, again, what would you want to build up most, tax-free dollars? Well, then I think we should start contributing to tax-free dollars first, maybe tax-deferred second, and taxable third. And when it comes to distribution, what would be the formula? Well, I think it's the opposite. I think we'd probably be taken from taxable first, we'd take from tax-deferred second, we'd take from tax-free last. Why? Because we want our tax-free money to grow as long as possible, so we have more money built up in tax-free. But the real answer is all three. We need to marry the distribution from all three so we can manage the tax that we're dealing with. Now, I didn't want to get into a seminar here. Sorry about that, but I get excited about this stuff because that's my job, and I've been doing it for a long time, and I want to share some ideas on how you guys can improve your financial life, right now. You might be asking, well, how do I take this and figure, and actually employ it? Well, if we get to that, we'll get to another question where I'll get into, I think, some more specifics about some takeaways. Because if you're spending your time here today, I feel obligated to give you at least some ideas that you can just simply take away from this and maybe go implement that, right off, either with your banker or with, hopefully maybe you've got a financial advisor and you tell that person, hey, I heard this strategy or this technique, what can I do in my own situation? So hopefully that'll help. Did I answer your question, by the way?
Yep.
Okay. Sometimes I can get off on tangents. My kids say I have ADD, which is probably true.
Another question that touches on this a little bit, but I know for me, I thought a lot about it when it was going through the early stages, and that is, how does Obamacare mix into the current insurability, the current pre-existing conditions, things like that, where we don't know what the future looks like. We didn't get to read it. We just heard people had voted on it. And now as it's coming to real life and we have to apply it and work with institutions that are applying it, what are some things that you can share to just enlighten our group?
Yeah. Thanks for the question, Jake. We live in the state of Minnesota. Minnesota is a progressive insurance state. For years, we've had what's called the Minnesota Comprehensive Health Association. And what that organization does, what that association does, all the insurance carriers that do business in the state of Minnesota are required by law to kick in a tax or kick in a premium to that pool. And what that pool is for folks who can't get coverage elsewhere. So even before we even get to that, my first question would be around, if you're currently working, you probably have health care through your employer. If, for example, you're losing your job for one reason or another, there's COBRA. It's a federal regulation, federal law that allows for a continuation of coverage. If you're being terminated from your job, you have 18 months of COBRA protection, where at the end of the day, you pay the premiums now. When you're working, your employer's typically subsidizing part of that premium cost. You may be kicking some of that money in as well. And after 18 months, then you have to find your own coverage, your own individual coverage. If, by the way, you're leaving work because of disability, you have 36 months of COBRA protection, okay? So there's this kind of succession. You've got your health insurance through work. Then there's the COBRA rules and regulations that will continue that coverage for 18 to 36 months thereafter. And then individual coverage. And let's say you can't get covered through individual health insurance. That's where MCHA comes in. We call it MCHA. It's Minnesota Comprehensive Health Association, administered by Medica currently. Yeah. It used to be administered by Blue Cross and Blue Shield for many, many years. And you might think, oh, that must be so expensive. It is not. It does cost a little more as the individual, as the patient or the subscriber for the premiums, but not that much more than individual coverage, because all these carriers, again, as I mentioned, are kicking in a premium or a tax to that plan or to that association to keep those costs down. The other thing is there are rules around carriers not being able to exclude you from coverage as long as you have continuous coverage. So if you're in a situation where you've always had health insurance coverage, the carrier can't reject your application for getting coverage, again, because of those rules. So every individual's different. If you're older and you're on Medicare and we're dealing with Medicare supplements and so on, that's a whole other kind of area of the medical rules and so forth that we'd have to get into. And by the way, if any of you have any specific questions, because I know in a big group, it's hard to ask questions about your own personal situation. You may not want to share data or details of it. By all means, I mean, I'm going to be here all day, so I'm happy to help anybody with any of the questions that you might have, and just come get me so we can talk about that specific medical. Oh, by the way, you talked about Obamacare. You know, because we're in a progressive insurance state, I think Minnesota carriers are going to do quite well under Obamacare, because one of the biggest things that's being created because of that law are these exchanges. And the exchanges are a method by which to create some competition amongst the states and so forth. Whereas, you know, like the carriers in Minnesota, the networks in Minnesota, they're bound by, you know, to be in Minnesota. But now all of a sudden those carriers can offer their product to folks in other states. And I think there will be a whole lot of competition now going across these state borders. And frankly, I think Minnesota companies are ahead of the game. You know, I think Massachusetts companies might be ahead of the game, that kind of thing too. But Minnesota for sure, I think will benefit from all of that. Just know, I think the most key ingredient here is just know that you can have coverage if you want it. And you can define and decide the specific type of coverage that you want. Of course, all of that comes at a cost, but there's that cost-benefit analysis that we need to do to figure out what's the right plan. You know, just the other day I had a client who was trying to figure out, well, given my prescription drugs, given how often I go to the doctor and the type of ways that I'm accessing care, what's the right plan for me? And we came to, in her case, interestingly enough, we came to an HSA, a health savings account, so that she could, yes, pay out of pocket a higher deductible, but save the money that she was saving on premium cost in an HSA, in a health savings account, which is a tax-free way to build up some wealth. I'm sorry if I take up too much time on this one topic, but let me talk about it a little bit further, because I think it's a great example.